Good evening, everyone. Thanks for dialing in to our first webinar for 2024. We are super excited to bring a new LoanX opportunity for our users this week. We actually launched the opportunity this morning, and it's called LoanX DAR June 26. LoanX is the product, DAR is the underlying originator or NBFC that we are working with, and the opportunity matures in June 26, and that explains the nomenclature. We will quickly, kick off with a quick round of introductions with our panelists today. So I have Aman Bhatia joining us. He is an AVP with the new initiatives in the legal team at GRIP and has been instrumental in the formulation of the LoanX product. We have Rishabh, Hasija as well. He is an AVP in new initiatives and credit. And we have and I'm the CIO for the platform and have been involved in bringing these opportunities to you as well. So maybe we can kick off with a quick introduction to GRIP. A lot of you already know us reasonably well, but here's a quick recap for those who have joined us for the first time. GRIP is an investor-first and transparency-focused platform for high-yield fixed income investments. We enable investments across 5 products for our users, and most of them are fixed income products. And we'll dive into those in a minute. But we are a SEBI-regulated platform. We are registered as a SEBI stockbroker. We also have a SEBI OBPP license, and we also have a CAT2 NAIF CAT2 fund. From a scale perspective, we have enabled close to 800 crores of transactions over the last 3 years, and we have processed, more than half of that has been processed as returns to our investors, and we have more than 25,000 investors on the platform. Just moving on, we have 5. Today we have 5 products, fixed income products on the platform. That's a quick recap. We offer corporate bonds, mostly with NBFCs that are rated anywhere, A minus or higher, and offer a 10 to 12% return. Then we have a product called BondX, which is nothing but a pool of corporate bonds that helps us diversify risk. And we offer that as an SDI. And we'll talk a bit more about that later, what SDI means. We have InvoiceX, which is nothing but that, invoices are invoiced by diversified pool of loans that are securitized and then sold to our users. We have LoanX, which is the product that we'll be talking about today in a lot more detail, and that's a diversified pool of medium-term loans, again originated by NBFCs that we securitize and sell to our users. And then we have LeaseX, perhaps the product that you're most familiar with, where we securitize these rentals from mission-critical assets that are leased to corporates. Each of these products that you'll see on the right side of the screen offers a different risk reward, all the way from BB through A+. And each of the products have their own return thresholds and offer pretty attractive risk-adjusted returns. Here's a quick recap of what we have achieved since the first time we launched SDI as a product for our users and in the industry back in October 22. We have undertaken nearly 200 crores worth of SDI products. These are, as we mentioned earlier, split between LeaseX, which accounts for just over 50% of the inventory, then LoanX, which is nearly 40%, and InvoiceX, BondX, which are our newer products, just shy of 10% collectively. We have worked with some incredible partners across these products, partners like BlueSmart, Zip, Furlenco, Everest Fleet. On the LeaseX side, on the LoanX side, we have worked with partners like Navi, Kirtana, VFS, Vedika, and DAR, which is the opportunity that we'll be talking about today. Um, and on the right, we'll see a split of these products by the rating, the credit rating. Um, Nearly a third, which is 36% of the products, are rated, just shy of triple B minus, so double B to double B plus, and then the balance two-third of the portfolio is rated investment grade, and that ranges from triple B minus through A plus, and we have also done one triple A product. But two-thirds of the portfolio that we have for our users, or opportunities that we have for our users, are rated investment grade by the credit rating agencies. I think we would have to explain a bit more about LoanX to you before we dive into the transaction. And for this, I'll request my colleague Aman to take you through what LoanX is all about. Aman?
Sure. Thanks, Siddharth. Hi, everyone, and very happy to be a part of this. So just before we dive into what LoanX is, just a quick background of what securitization is. And why is it necessary? So NBFCs typically face two kinds of risks. These are liquidity risks and solvency risks, and they use different modes of capital, modes of instruments to raise capitals. So, for example, they would either go ahead with bond issuances, and these could be NCDs, which are also available on our platform, or they would use securitization as a risk management tool. And that is the one that we're going to talk about today. So LoanX is an instrument which is a form of securitization. It allows investors to basically earn fixed monthly rentals by purchasing a pool of cherry-picked loans. And there are honestly just four simple steps to putting together a transaction. So these are identifying an NBFC, and that NBFC is responsible for underwriting and providing loans to a pool of borrowers. Once the NBFC has identified this pool of borrowers, it will securitize these loans, which is assign those cherry-picked loans to a trust. This trust is an independent SEBI-registered, managed by a SEBI-registered trustee, an independent trust, and the trust purchases these loans. Against the purchase of these loans, it issues what is called as securitized debt instruments, and LoanX is a form of that, to investors. And once this entire transaction is done, these investors effectively become the owners of these loans. So they are then entitled to receive any monies which come back, which is the principal and interest repayments that are paid against these loans. So that's the process of securitization as a whole, and what LoanX does, and GRIP basically acts as a manufacturer in these transactions. This product LoanX is not new. Of course, this is the first time GRIP is making it available to institutional investors, to retail investors. However, institutional investors have been active in this for quite some time. On the left side, you will see a graph of how the securitization volumes are expected to grow. So they're expected to grow at a CAGR of about 35%. And just this year, it has clocked almost 176,000 crores in volumes. And on the right side, you will see the institutional investors that are active in this market. So you will see all the marquee names from the HDFCs to the JP Morgans. All of them have been participating in purchasing these loan pools. And now talking about the investment highlights of LoanX. So the first one is that a LoanX offers a cherry-picked, diversified loan pool. GRIP's team underwrites and cherry-picks what kind of loans we would like to pick up. And these are typically diversified personal loans, MSME loans. All of these loans are itself originated by an investment-grade NBFC. However, these loans are picked up and put into a LoanX instrument, which you can invest in. This LoanX instrument can offer an attractive risk-adjusted return. So we expect returns to be anywhere between a 12 to 15% IRR pre-tax range. And it for us, compared to a similarly rated corporate bond, you can expect almost a 200 or 250 bips higher return. Of course, the returns, like most other GRIP products, comes back on a monthly basis, and both principal and interest are returned on a monthly basis, which results in a much shorter weighted average holding period. All of these instruments come with a robust security package. So there is uh, the package typically comprises of a cover of about 30 to 50% of the investment amount, and the package will comprise of typically three components. These could be a cash collateral, an EIS, and an over collateralization, all of which we will cover later in the slide in this deck below. The instrument itself is an RBI and SEBI regulated instrument. It is executed, the entire transaction is executed in line with those regulations. The instrument itself is listed on one of the exchanges and it's issued in demat form. So you can actually invest in this instrument much similar to how you buy bonds on the platform. And on our platform, you can, it's a sort of almost like a single click process where you can go and make an online payment and purchase these bonds. And then the taxation structure is quite transparent. So you only pay tax on the interest component and not of course, the principal is tax exempt. So LoanX actually has been recently covered in one of the publications by Mint as well. And Mint has rated LoanX in the risk reward or risk return chart. They basically rated it at almost at par with on the risk parameter, almost on par with investing in a Nifty 50 index fund. And yeah, that's the takeaway here.
Yeah, and just to maybe add to what Aman mentioned, so on the risk parameter, GRIP LoanX product has been rated, as you will see, lower than the Nifty 50 index, which is right here. We have boxed the the GRIP LoanX logo there, and on the return side, it's also in line with Nifty 50 index fund. So it's you'll in particular notice that with respect to invoice discounting, P2P lending, it's actually a lower risk product with more security, and it's also a higher return product. And this is just third party coverage from Mint and what they felt about the product. I'll probably move on, and we'll now dive into the opportunity. And the opportunity, as we mentioned earlier, is with an NBFC called DAR. And I'll request my colleague Rishabh to speak a bit more about DAR as an NBFC, and then dive into the instrument itself.
Sure. Thanks a lot, Siddharth. So hi, everyone. Good evening. So let's talk about what the Originator NBFC is, and later on we can speak about the opportunity itself, right? So DAR Credit and Capital Limited is it's a 3-decade-old RBI registered NBFC that has an AUM of approx 160 CR. So two key loan products of DAR are, one is personal loans, which they give to permanent grade 4 employees of municipal corporations, and second product in which they deal is unsecured MSME business loans. And the key factor or key aspect about their personal loan segment is that they have relationship with around 200 municipalities. And what they do is that they have such an arrangement with the municipalities, wherein these municipalities deduct EMIs from the salaries of their permanent employees who are taking loans, and the salary is paid after deducting the EMI, which is then remitted to DAR. So that's a key feature of their personal loan, which is slightly different than other conventional personal loans which are available in the market. Right? So DAR is a around 30 years old NBFC. They are PAT profitable. They're PAT positive with around 11% PAT, and they have a debt equity ratio of 2.15 times. And they're adequately capitalized with a capital adequacy ratio of 45%. And if you talk about the leadership team, the management of DAR, so all the key management employees have 2 to 3 decades of experience in banking and finance sector. And these are the people who maintain relationship with the municipalities and are key responsible persons for the day-to-day functioning of the company. And if you look at the bottom part of the slide, DAR has quite a lot lending partners. So some of the key lending partners are SBI, PNB, Tata Capital, SIDBI, Black Soil, and Mass Financial Services as well. So yeah, their their debt side is also quite diversified. So moving ahead, let's talk about some key numbers. So DAR has disbursed around 30,000 loans till date, and they have been able to maintain a quite a good collection efficiency ratio of around 95.4%. And you can see that the AUM of DAR was earlier in the range of 221 CR, which dipped in next 2 3 years, and then currently it's at around 160 CR. Would like to highlight what are the key reasons due to which you can see a dip in the AUM of the company, right? So first of all, earlier DAR was also in the business of providing supply chain financing short-term loans to MSMEs, for which they were partnered with a co-lending partner, through which they were leveraging their platform. And that partner was not a NBFC at that time, but in FY20 or towards the end of FY20, they acquired the NBFC license. So therefore, that business shifted. Therefore, you can see a dip, a huge reason was that the supply chain financing business shrank. So, but after that, company started to focus on personal loan, but personal loan also couldn't scale up due to COVID in FY21 and FY22. So they were quite stringent in terms of eligibility criteria while disbursing these loans. So therefore, that couldn't scale up. But starting FY23, they started to scale up their personal loan as an unsecured MSME business loan, and now the traction should continue in the coming years. So yeah, but now they are at 160 CR of AUM, and and the ticket size in which they disperse loans is 100K to 200K, and 200K to 10 lakhs. These are the key buckets in which they provide these loans. We can move ahead probably. Yeah, so moving ahead, we can talk about some key aspects of the underlying LoanX opportunity, LoanX DAR June 26. So this opportunity entails a pool of personal loans, which we were talking about earlier. These personal loans are given by DAR to permanent grade 4 employees of municipal corporations, right? And as all our LoanX opportunity, this is also rated, and the rating is triple B plus. This is listed on BSC and comes with a tenor of around 30 months. Now, if we talk about returns, so this opportunity has a pre-tax return of 14.5% and provides monthly cash flows in form of interest and principal payout. And the underlying pool has around 312 borrowers. Again, as I mentioned, these are permanent employees of municipal corporations. Yeah. So now let's talk about the security package which is available in the transaction. So there are 3 components of security package, and I'll try to explain each one of them very briefly. First one is over collateralization, which is to the tune of 12.1%, which essentially means that the underlying transaction has access to some additional loans. For example, if the underlying loan pool is of 112 loans, 112 rupees of loans, to which the securitization is happening for 100 rupees. So there's an excess cash flows coming from those 12 rupees of loans, which are also assigned in the transaction and is acting as a security cover. That's called as over collateralization. Then the second component is cash collateral, which is in form of FD, which is lien in favor of investors. So that is 8% in this transaction, which is highly liquid. And the third key component is excess interest spread. Many of you might already know what this is, but I will reiterate. So excess interest spread, which is 21.5%, is an extra stream of cash flows, which is in form of interest, because the underlying loans, which are given by DAR, had a are at a higher coupon rate as compared to the coupon or the returns of the transaction. So there's an extra stream of cash flows in form of interest, which is available for the investors, and trust slash investors can dip into this all these three components as and when need arise in the transaction. So these three are the key security components, and we have already spoken about DAR, their AUM and everything. And yeah, another good point to highlight is that they reported gross and net NPA of 0.5% and 0.35% recently in September 23. So these are the key characteristics of uh, this underlying opportunity. Moving ahead, we would want to highlight what are some key aspects due to which we really like this opportunity and why this is different from other opportunities available in the market. So first of all, the 14.5% return is there in this transaction, which is 150 basis points higher than a similar rated corporate bond. And also because of the security package, the capital protection is in such a way that all your investments are protected in 20 months. So despite of a 30 months tenor, because of the security package, all your investments are 100% covered in 20 months, fully covered in 20 months. And as we spoke earlier, the collection structure, the municipal corporations are directly deducting EMIs from the salaries of the permanent employees slash borrower. So as an NBFC, DAR doesn't has to have to go to each and every borrower to follow up for recoveries and all. So quite a different and unique recovery mechanism. And since these are all permanent employees, but despite of that, if any employee is leaving the organization, then also the EMIs of DAR are prioritized as per the arrangement, and the dues are settled from full and final settlement. DAR has a quite a long relationship with most of these municipalities. So top 20 municipalities, which cover a very large portion in the pool, DAR has maintained a more than 10 years relationship with these municipalities. And the third good aspect about this opportunity is a high security cover. So weighted average security cover is 1.51x in the transaction, and due to the security cover, up to 26.5% of defaults are fully covered. So that's because of the OCCC and EAS, which we have spoken about, 26.5% of the defaults are fully covered. So that these are the three important aspects. And yeah, DAR has also done a transaction with the leading financing player, Hinduja Leyland Finance, which is very active in the PTC slash STI space. So they have done a transaction with them as well recently. Yeah. So moving ahead, this slide just depicts how the security package keeps on building up, keeps on increasing as a percentage to outstanding principal as the transaction amortizes. So therefore, you can see the light blue line as the principal, which reflects the principal. So as the principal keeps on amortizing, the security cover, which is depicted by the dark blue line, it keeps on increasing. So therefore, we mentioned that on a weighted average basis, it's 1.51x, and all your capital is protected in 20 months because of the security package. Yeah, so this slide depicts more of what the pool looks like. So as I mentioned earlier, this pool is fairly granular. So there are around 312 borrowers spread across 67 municipalities. And again, these 67 municipalities are in Rajasthan, MP, and Gujarat. And there are around 41 districts to which these borrowers entail. So that's how the pool is diversified, and the average ticket size of the underlying loans is INR 189,000, and the weighted average balance tenor of these loans is again 30 months. That more or less corresponds to the deal tenor as well. So these were some key points about the underlying pool.
Thanks, Rishabh. That brings us to the end of the opportunity overview with DAR, and we would love to take a few questions from our users. We can see a couple of questions trickling in, and we'll start answering them during the webinar. And please feel free to post post additional questions as you think through the opportunity. The first question is, why is the NBFC taking money here on such high interest rates when they can collect funds easily from investor on much lower interest rate than this? Maybe I can take this one. Really, as Aman explained to begin with, NBFCs have, they have a couple of needs. For capital. One is to cover their solvency risk, and the other one is to cover their short-term liquidity risk. The rate at which NBFCs, as you already know, borrow capital is a function of their scale, their credit processes, their for how long those NBFCs have existed and their track record, their collections, NPAs, and all of that comes together in giving an NBFC being rated by one of the rating agencies. And the cost of capital at which they raise debt is also a function of what their rating is. DAR in this case is is a triple B minus rated NBFC. This product itself is triple B plus. Both the ratings are from CARE, and they are raising capital at their cost of debt. NCDs or corporate bonds is just a bit north of where our opportunity is priced, and because our opportunity is more secure than the corporate bonds, and it's 2 notches better rated, they are the return on the opportunity is marginally lower than what the corporate bonds would trade at, or where they would issue those corporate bonds. So really, you would see an NBFC like this raising capital at anywhere between 13, 14, 15%. You also have AA, AAA rated NBFCs that would raise capital at 8, 9%, and that's really the football playing field for NBFC's ratings and the pricing at which they raise that capital. So that's the reason why DAR is raising capital at this price. Whether it was from Hinduja, an institutional investor, or it's from the GRIP platform. The next question is, can you please explain the security package again? Maybe Rishabh, if you would like to take another crack at just explaining over collateralization, cash collateral, and the excess interest spread, that would be really helpful.
Sure, definitely. We can talk about it. So, as you can see on screen, so over collateralization is 12.1%, right? Which means that the underlying pool, the underlying pool is worth is the pool of loans is worth rupees 112. But what we are securitizing, or the loans which are assigned or for which the funds are being raised from investors, are say 100 rupees, right? So for 100 rupees loans, the loans worth 112 have been assigned in the pool or have been assigned in favor of investors. Which means that the cash flows pertaining to those additional 12 rupees loans are also flowing through underlying trust or through investors first. That means the investors will always have access to those additional 12 rupees loans which are there in the pool. Therefore, this security component, which is over collateralization, provides an additional cover, and the trust can dip into this as and when the need arises, as and when the default situation arises. So that's what over collateralization is, and this is a very conventional, and this is a very normal security component in most STA transactions which are happening in the industry. Second component is cash collateral, which is fairly simple. So this is an underlying, this is an FD, which is lien in favor of the investors or in favor of this transaction. So again, this is highly liquid with a nationalized bank, and this will be there in the transaction throughout the tenor. And the quantum of this is 8% of the overall transaction size. The
And
third,
really think of it as a security deposit.
yeah, just as good as security deposit, because this is highly liquid in form of FD. The third component is excess interest spread. So as we have already spoken about, that DAR as an NBFC is disbursing loans at a higher coupon or at a higher uh, interest rate to the investor, because these are essentially unsecured loans to permanent employees of municipalities. Therefore, the coupon is comparatively higher. But what is being offered to investors is comparatively lower coupon, or for say around 14.5%, right? So because there is some additional security package, there's some diversification. So we've already spoken about why why there's a difference in the coupon. So due to this additional cash flow, which is there in the form of interest, all those additional interest cash flows will be first flowing to the investors, or rather in trust account first. And trust will always, which is beneficiary entity on behalf of investors, will always have access to this additional stream of cash flows, and they can anytime dip into this. Therefore, it's again a very highly liquid form of security component that is also available in the transaction. And this number is also reported in the rating rationale if you want to go through it. Again, this is also a very normal and basic security component which is there in all STA transactions happening in the industry. So I hope this clarifies. I was able to clarify what security package is. But feel free to ask if there are any other specific questions, and we're happy to clarify those.
Thanks, Rishabh. The next question is, what percentage of amount is contributed by DAR and Grip Invest? Um, so, as DAR's skin in the game, they are providing 8% cash collateral, as Rishabh explained a short while back. That's really their skin in the game. And they are also providing an over collateralization of 12%, right? So that's DAR's skin in the game as an originator. And Grip Invest is an arranger in the transaction. We are not an originator ourselves. We have manufactured or put this transaction together along with DAR, but we are really an arranger in the transaction. Having said that, the Grip uh, team often invests in the deals that it brings to our users, but in our capacity as an arranger, Grip is not required to invest in this transaction. The second question from the same user is that the DAR is charging interest of more than 20%, while the IRR is less than 15%. Rishabh, covered this just a short while back, that the underlying loans that DAR is giving to these municipal employees are unsecured loans, and that's why the underlying interest rate is north of 20%. What DAR does, and what we have done, what we have arranged with DAR is essentially collating all of these pools together, or 312 loans, and it's a collection of loans. So it's a highly diversified pool. And then DAR has added the security package to that pool of loans. And as a function of that security package and diversification, the return for such instruments, not just for our users, but such instruments across the market, is lower than what the underlying loan interest rate is. And the delta that's between the underlying loan interest and the interest that the user is receiving is what's really the excess interest spread. And so if there are any shortfalls in meeting the IRR obligations or interest obligations towards our users, they will be made up by the excess interest spread, which just to be clear again is the difference between the interest rate of the underlying loan and the interest that our user or our investor is getting. And this is how the product works across the industry. The next question is priority payment and collection structure. Is there any tie-up with the municipal authorities? Rishabh, would you like to answer that one, please?
Yeah, sure. So, rightly said, there is a tie-up with the municipal corporation. So, for all the our pool entails 67 municipal corporations. So, but DAR has been working with these municipal corporations since long. So they enter into an arrangement with these municipal corporations and they sign all the required documents, undertakings, etc. with these municipal corporations. And in all those documents, they provide right to the municipal corporations to deduct EMIs from the salaries of the employees. And as per all these documents only, whenever an employee leaves or if their full and final settlement of any employee is happening, so those municipal corporations are authorized to deduct DAR's EMIs from whatever sum of what from all the salaries or full and final amount that is available on priority. DAR's EMIs will be deducted, and then the remainder will flow back to the employee or their family members. So you rightly said. So there's an arrangement through which this is governed, and everything is documented in agreements and all.
Thanks. Thanks, Rishabh. The next question is, what is the average duration of this load spread versus loan amount? Maybe I'll take a crack at that. I think maybe the intent is to ask what is the maybe we can answer it in two ways. One is both, from a duration perspective, and second is from the interest spread perspective. So the underlying loans, as Rishabh alluded to earlier, on a weighted average basis, have a balance tenure of 30 months. This instrument, this A1, this senior secured PTC is also has a 30-month expected tenure, while in 20 months your capital will be fully protected given the security package in the transaction. And we covered this earlier as well on the interest spread side. The underlying loans are in the vicinity of 25-26%, whereas our users are getting an IRR of 14.5%, and that's due to the security package in the transaction. The next question is, what is the loan vintage of the security pool? Rishabh, maybe you can answer that and explain the vintage ones through these pie charts, please.
Sure. So, as mentioned on top of this page as well, so the underlying loan pool has a weighted average vintage, or it's the technical term for is a seasoning of say 18 months. So, so collectively, if you look at it, so 18 months is the vintage of the underlying pool. And in addition to that, there is RBI also recommends that for securitization or for doing such a transaction, only only loans which have a specific vintage can be assigned in such a transaction. So RBI also recommends a number for that, but this is way higher than that. I think that is 6 or 9 months. Sorry, I think it's 6 months, but this is much higher than that. The track record or vintage is for 18 months in this transaction. So, yeah.
Thanks, Rishabh. The next question is whether we could talk about the cash flows of LoanX. You can definitely check out the transaction on our platform, and you'll be able to see all the cash flows there. But maybe I can request Rishabh to spend 30 seconds on the slide again, which shows really how the principal is amortized and security package increases over time.
Yeah, definitely. So, so if you see over here, the light blue line, right? So over the 30 years, over the 30 months tenor of the instrument, principal keeps on amortizing, right? And if we look at the security package, in the first month, after say end of first month, it is 23%, but it keeps on increasing along with the dark blue line in this graph as the pool or as the principal amortizes in the transaction. So therefore, you can see that when we will reach M21 or say 21st month, the security package would be 100% equal to the outstanding principal. It will 100%, it will fully cover the underlying outstanding principal. And as we move further, so it will go even more. It'll go to say 7,000% or whatever. But the crux is that the way to look at it or to normalize it is by looking at weighted average security cover, which is 1.51x throughout the tenor of the transaction. Throughout this 30 months tenor, on a weighted average basis, it is 1.51x. And your investment amount is fully secured in 20 months. So because of the same concept, as and when the payments are made each month, the outstanding principal keeps on amortizing, and the security cover becomes more stronger every month. In other words, the risk keeps on reducing as we proceed towards the maturity of this transaction. This will, once you look at the deal on our platform, once you look at the cash flows, once you look at the return calculator, the things will be amply clear. And I mean, these calculations are fairly simple. You can also calculate it yourself. But yeah, the summary is what we discussed just now.
Thanks, Rishabh. The next question is, how does DAR intend to grow its business in 2 years' time, keeping in mind that they are aligned with the municipalities, and how many states they intend to explore in a couple of years? So DAR today is present in 3 states, and they have aligned themselves with more than 100 municipalities. Out of those 100 plus municipalities, we have 67 municipalities in our pool, and DAR is continuing to, in the coming years, they are increasingly looking to expand their book with such municipal employees, and also expand to other states beyond the ones that they are already present in. And the key one for them today is Rajasthan. So with everything that we know, they are definitely looking to expand to other states and more municipalities. The next question is, there is a TDS of 25% on this transaction, and that's higher than corporate bonds. Aman, would you like to comment on that?
Sure. The TDS requirements are basically coming in from the regulations. So of course, there's a 25% TDS, but that is only on the interest component. And just as an example, so for example, if you look at the first month's payout, and effectively you're only deducting anywhere around 600 rupees on a 15,000 monthly return that you will get. So that's just the key point to remember, that it's only applicable on the interest and not on the principal portion that will be returned to you.
Thanks, Aman. The next question is, how has been the performance of other LoanX on GRIP till date? So GRIP has launched till date 6 LoanX transactions. And the first LoanX transaction was back in the summer of 2023. I think this was around July of 23 when we first launched our LoanX, July or August. And so far, there have been nil defaults in payouts across all the transactions. These transactions have been rated anywhere between a BBB minus and a A and a AAA. And all the originators that we have worked with so far have performed in line with the underwriting, or even better than, in a couple of cases, better than what we had underwritten. The next question is there any loss default guarantee
Sid,
from
maybe-
the NBFC?
So it may be worth mentioning that in few of our LoanX deals, we have actually made
I think what Vivek has alluded to is, we have actually made prepayments in some of our LoanX transactions, which really means that the underlying borrowers of those NBFCs ended up repaying their loans, and which is essentially paying their loans faster than what was scheduled in their loan documents. And as a result of that, our investors were also prepaid their principal, which de-risked the transaction for them. The next question is there any loss default guarantee from the NBFC, and if there is any personal guarantee from the promoter? So there is no, there is a again, there is a cash collateral of 8%, which is a security, sort of a security deposit from the NBFC, and there is also an over collateralization of 12%. Um, uh, and so that's really the NBFC skin in the game. There is no personal guarantee of the promoter, and the reason is that by RBI laws, these transactions, these PTC transactions, need to be bankruptcy remote, or in other words, uh, the originator decides the security package that the originator has put in at going in at closing of the transaction. There is no further reliance on the originator from a security perspective, or the originators, promoters, and that's why across the industry these transactions do not come with any personal guarantee of the promoters, or any corporate guarantee of the originator, other than the over collateralization and cash collateral the originator has already put in the transaction at going in. The next question is, whether are there standing instructions for the employee account directly to deduct the EMIs. Rishabh has already covered this, but maybe Rishabh, if you want to cover this once again in 30 seconds, please.
Yeah, sure. So standing instructions are not. This is the term which is generally used for banks, but there's no standing instructions given to bank. In fact, the payment or DAR's EMIs is deducted by the employer itself, which is municipal corporations, before making the payment to employees. So after deducting the EMI, whatever is net amount that is disbursed, that is remitted to employees. To the second part of the question, even the question is directly deduct even if they have nil account. So again, so DAR has a specific eligibility criteria basis which the disbursement is done to employees of these municipal corporations or borrowers, and they do make sure that the underlying borrowers, they will disburse the loans only if they have if they meet certain loan to income ratio criteria. They will check for fixed obligation to income ratio. They will check for all these proposals or all the leads which they get. So they will apply a specific eligibility criteria, and they despite of that, even after disbursing the loans based on eligibility criteria, they do make sure that the net take home salary is meaningful for these employees. So a lot of criteria which they implement while disbursing the loan. So the situation will never arise when there's a uh, nil balance for deduction.
Thanks, Rishabh. The next question is, I think the cash collateralization in the form of FD is created from the loan pool itself, collected from the retail investors. So the IRR is less. It's not the DAR is putting in the skin of the game. No, that's not the case. We would like to debunk this myth. DAR actually puts in, additional cash from their balance sheet in the transaction, and the investor's capital is not used to create any security package, whether OC or CC, in the transaction. DAR actually puts this capital from their balance sheet, and these security measures of OC and CC are also regulated by RBI, and so there is no security creation from investors' capital, and it's truly the originator's skin in the game. The next question is, what is the simple interest rate at which LoanX would be amortized? So, the simple interest rate for a 14.5% IRR is close to 13.6%. And that's the rate at which the transaction will be amortized. The next question is, who will monitor the security stipulation? Is it a security trustee? Aman, could you please take that?
Sure, absolutely right. So in every transaction, basically there is a independent SEBI registered debenture trustee who is the trustee of that of the SPV that purchases these loans, and that trustee is sort of responsible for ensuring that the transaction documents are followed, filing returns with the exchanges, filing returns with the credit rating agency on a regular basis. There is also a concept of someone called as a servicer who's responsible for ensuring that the collections happen on time. and providing a report to the trustee so that the trustee can carry out its own actions on a timely basis.
Thanks, Aman. The next question is, what is the average tenure of the loan? The average tenure of the entire loan is close to 48 months. Having said that, these are the underlying loans to the municipal employees. Having said that, on an average, these loans have a prepayment track record of 18 months. And this is when we are doing the deal, when we have already seen that none of these employees have, or municipalities have defaulted for the last 18 months on their loan payments. And now the average balance tenure of the loan is, the underlying loans are 30 months. The next question is, what would be the average CIBIL score of the loan pool? A lot of these, so CIBIL is not necessarily applicable, or not every NBFC looks at the CIBIL score while giving out the loans. They each have their own credit criteria. In this particular case, in DAR's case, for them, Rishabh did mention some of the criteria earlier, but CIBIL score is not a criteria. The criteria is that the employee should be a permanent employee of the municipality and should have been employed for at least 2 years with the municipality. And then there are additional KYC requirements, additional requirements around their net take-home salaries, and what's the loan-to-income ratio, and so on and so forth. But these employees DAR doesn't necessarily look at the CIBIL score of these employees, or a lot of these employees might not necessarily have a CIBIL score. And that's why, they are taking unsecured loans from DAR at interest rates that are north of 20%. The next question is, what's the total size of the LoanX transaction? The total size of the LoanX transaction is nearly 5.2 crores. It's 5.19 crores. The next question is there any overlap on cash collateral plus over collateralization with other instruments? Are these exclusive? Aman, would you like to answer that, please?
Sure. So, the cash collateral that we mentioned is, of course, available in form of a separate FD, which is lien marked in favor of the trust. So that's, of course, kept aside completely. The over collateralization is, like we explained, was an additional principle that was available, and the EIS was effectively interest that is generated on that over collateralized component, as well as the underlying loans that have actually been purchased. So the difference between the rate at which the instrument is returning capital and the rate at which the underlying loans are operating. So they are seen as exclusive components effectively. Siddharth, if you want to add to that.
No, I think that covers it well. Thanks, Aman. The next question is, DAR has big houses as lending partners such as SBI and PNB. What made them come to GRIP to raise money at high interest rates? Is it because banks demand collaterals and they get cheap capital directly? So, again, maybe if we look at the various options that an NBFC has to raise capital, the first port of call, of course, is national banks, public sector banks, and large private banks, right? So you would have the likes of SBI or PNB, and then among the large private sector banks, you would have the likes of an ICICI or HDFC and the Kotaks. These banks they typically provide working capital loans and would range anywhere around, depends on the rating of the NBFC, but in this particular case, they would range around low double-digit interest rates. So, roughly 11, 12, 13%. And then they raise NCDs, or they raise money from corporate bonds. And these corporate bonds are issued to institutional investors, family offices, individual investors, and they raise money at slightly higher interest rates, closer to 15 or just north of 15 for a triple B minus rated NBFC. And then they do PTC transactions, wherein they would, they would add more security and package a bunch of loans together and securitize them, which have a lower risk and a slightly lower reward than the NCDs of these originators. So there is, the same originator has also gone to has also worked with an institutional investor like an Hinduja Finance, and there is no and these originators work with lenders or capital partners across the board, be it a nationalized bank, be it a wealth tech platform like Grip, or institutional investors or family offices, and each transaction has its own risk reward, and we all bring our own value to the table for such originators. The next question is whether the ticket size for investing in LoanX is prescribed by regulator as too high or for retail investors. Aman, could you please cover that?
Sure. Yeah. So just a bit of background is that privately placed debt instruments were up until last year available at about 10 lakh rupees face value, and in the last 1 year, SEBI has been taking a lot of actions to sort of reduce that face value even further for investors to encourage retail participation, and they came up with specific guidelines to reduce that to 1 lakh face value. And there is now a consultation going on to reduce that even further to 10,000 rupees.
Thanks, Aman and Rishabh, for sharing your thoughts. And thanks a lot to our audience for listening to this opportunity. And please reach out to your respective relationship managers or contact us through the Grip platform to learn more about it. As you reflect on the opportunity, if you have any further questions, please don't hesitate to reach out. We are at the top of the hour, and we see there are a couple of more questions, but in the interest of time, we will close the webinar now, but we would definitely encourage you to reach out to your RMs or through the Grip platform to have answers to any other questions that you might have. Thank you so much, and have a great evening ahead.